The typical actively managed mutual fund in America charges you 1.2% annually in expenses. The Vanguard S&P 500 Index Fund charges 0.03%. On $200,000 at 7% yearly real return over 30 years, that gap does not cost you $20,000. It costs you $370,000. In compounding, you never collected extracted quietly mechanically before you ever realized it was occurring. And here's the element that transforms it from regrettable to ironically amusing. 9 out of 10 of those pricey active funds still trail the inexpensive index they are designed to outperform. They levy more. They produce less. This has been recorded publicly for 40 straight years. Billions of dollars keep flowing into them every quarter. That is not a scheme. That is incentive structure. The fund manager receives compensation whether you profit or not. You are financing their escalator while you climb the stairs. Which leads me to everything this video is genuinely about. I spent a decade in banking, then another decade operating my own company surrounded by accountants and tax attorneys who discuss money the way most individuals discuss the weather constantly, casually without theatrics. I have multiple hundreds of thousands of dollars deployed right now. This is not hypothesis. Today, I am going to provide you the structure I genuinely employ, the arithmetic that genuinely counts in early 2026, and the psychological snares that will deplete more of your wealth than any market collapse ever will. None of it demands a Bloomberg terminal, a financial consultant, or a functional grasp of options Greeks. Incidentally, I developed a complementary early retirement calculator because most digital ones are mathematically flawed. It employs BlackRock and Vanguard reasoning to reveal the vulnerable spots in your strategy, and I solely request your email to deliver the report. So I do not retain any of your financial information. Link is in the description. In the E, now everything I'm about to share with you circles back to one singular concept. The market is an escalator, not a spacecraft, not a slot machine, an escalator. It advances upward gradually, mechanically, with periodic disruptions that alarm everyone standing on it. But across any 20-year span in contemporary financial history, the S&P 500 has risen. Through the Great Depression, through 2 world wars, through the stagflation of the 70s, through the dot-com collapse of 2001, through 2008, through a worldwide pandemic that paralyzed the entire physical economy, 10% yearly in nominal terms since 1926, 7% after inflation, the escalator ascends. The complete game, the sole game is remaining on the escalator long enough for the arithmetic to operate in your benefit, and the complete financial media apparatus, the complete active fund management sector, the complete culture of trending picks and market timing. And this occasion is unique. All of it exists to remove you from the escalator, not maliciously. There is no revenue model in advising someone to purchase a low-expense index fund and disregard it for 20 years. Mundane does not generate advertising revenue. Mundane does not validate a 1% management charge. So the escalator continues operating and the sector continues fabricating reasons to panic in the stairwell. In several minutes, I'm going to demonstrate precisely how much wealth that panic depletes in actual dollar figures. But first, here's why the expense problem is even more dysfunctional than you imagine. And it originates in a location most individuals never examine. Most individuals with a 401k through their employer have no concept what they are genuinely invested in. They navigated through an enrollment interface 6 years prior, selected something labeled Balanced Growth Fund, or Target Date 2050, and have not accessed the account since. The expense ratio, the yearly charge extracted mechanically, irrespective of whether the fund generates profit, is operating in the background right now, compounding against you every single day. The typical expense ratio on an actively managed U.S. equity mutual fund is approximately 1%. The Vanguard S&P 500 Index Fund, VOO, charges 0.03%. That represents $3 annually on every $10,000 invested versus $100 for the identical balance in an active fund. Appears like a negligible difference. Projected over 30 years. Suppose you are 35. You have $50,000 accumulated and deposit $500 monthly going forward. At 7% real yearly return in a fund levying 1%, you retire at 65 with roughly $740,000. The identical deposits and market return in a fund levying 0.03% produces roughly $960,000. Same market, same individual, same deposits, different fund. That $220,000 disparity did not flow to your retirement. It flowed to a fund manager who has almost certainly trailed the index they were intended to outperform. That is not me being theatrical. The S&P Dow Jones Indices SPIVA report published yearly, peer-reviewed monitoring active fund results against standards found in its 2024 publication, that over a 20-year duration, roughly 93% of large-cap active funds in the United States trail the S&P 500. 93%. You paid a premium, you received a reduction. The escalator continued advancing at the identical pace regardless. And you surrendered someone $220,000 for a slower passage. The remedy is nearly insultingly straightforward. Navigate to every account you possess, 401k, IRA, brokerage, and locate the expense ratio on every fund you maintain. Anything exceeding 0.1% in a broad market fund is depleting compounding you did not consent to surrender. Transition to the lowest expense equivalent accessible in your plan. One action, assured positive expected value, the greatest return per hour endeavor in personal finance. Now, before we arrive at the conduct that depletes even more than expenses, and it depletes considerably more, I want you to encounter Marcus. Marcus is 42, intelligent individual, accomplished career in supply chain management, $130,000 annually. Unlike most individuals, he genuinely commenced investing properly in 2015. He established a brokerage account, deposited $30,000 in a diversified equity fund, configured $800 monthly in automatic deposits, and declared to himself he was committed for 20 years. Model escalator conduct. Then February of 2020 materialized. The S&P 500 plummeted 34% in 33 days. The financial media was forecasting depression-caliber consequences. Marcus observed his account decline over $40,000 in 5 weeks. In late March, he liquidated everything. He did not desire to. He assured himself he would not. But the escalator was trembling violently, and every rational impulse in his body instructed him to step off. The S&P 500 reached its COVID trough on March 23, 2020. By December 31st of the identical year, the index had completely recovered and reached new record peaks. The complete catastrophe on a 20-year graph is a minor fluctuation. If Marcus had remained on the escalator, the most devastating moment of his investing existence would have been imperceptible in retrospect. Instead, he secured a real loss, lingered on the periphery attempting to identify the proper re-entry, purchased back near the peak in late 2021, and experienced the 2022 rate increase decline down another 20%. Marcus did not render foolish choices. He rendered entirely human choices. The difficulty is that markets do not compensate human impulses. They compensate the absence of human impulses. We are going to revisit Marcus. His account carries a second chapter, and it concludes in a manner that makes the entire narrative worth sharing. Okay, so here is what everyone constructing their own approach gets incorrect, and the evidence on this is devastating. Remain with me because this following segment transforms how you conceptualize risk completely. Incidentally, press subscribe if you are receiving value here. Otherwise, the platform's algorithm genuinely may not display my content again. JP Morgan Asset Management issues an annual publication called Guide to the Markets. In the 2023 edition, they monitored a $10,000 deployment in the S&P 500 over 20 years from 2003 to 2022. Remain completely deployed for all 20 years. $10,000 becomes roughly $64,844. Miss the 10 strongest days out of 7,300 total trading days. $10,000 becomes $29,708. Miss 10 days out of 7,300. Forfeit more than half your aggregate returns. Here's what renders that figure genuinely unforgiving. 6 of those 10 strongest days transpired within 2 weeks of the 10 weakest days. The largest single-day advances occurred directly following the largest single-day declines, which signifies if you liquidate during a decline, which is the sole emotionally logical reaction to observing your portfolio fall 20%. You are statistically virtually assured to miss the rebound. The act of shielding yourself eliminates the result you are shielding. You believe the difficulty is selecting the correct investment. The difficulty is not liquidating the investment you already selected, and this is not a hypothetical failure pattern. The analysis on real investor conduct demonstrates that the typical retail investor generates 2 to 3% less annually than the funds they possess. Not because they selected inferior funds, because they purchased after markets ascended and liquidated after markets descended every year reliably despite comprehending the principle. This disparity between what a fund delivers and what the typical investor in that fund genuinely collects carries a designation. The behavior gap pioneered in the work of behavioral economists Shlomo Benartzi and Carl Richards. It is genuine, it is substantial, and is wholly psychological. On $200,000 over 25 years, a 2% yearly behavior disparity depletes roughly $330,000 of ultimate wealth. $330,000 not from inferior investments, from superior investments liquidated at inferior moments. The escalator was ascending the entire duration. You simply continued stepping off. Now, here's something your financial consultant probably never articulated openly. Trading more frequently is not a route to superior returns for retail investors. A 2020 analysis in the Journal of Finance examined over 60,000 individual brokerage accounts and discovered that the top 20% of traders by frequency underperformed the bottom 20% by greater than 7% yearly after transaction expenses. The most active investors produced the worst net returns. Conviction and exertion and screen time were inversely correlated with results. This is not an argument opposing education. It is an argument favoring candor about expected value. Picture an individual at a gathering confidently describing why he shifted out of technology into commodities in October and then returned into technology in December. His aggregate return for the year -4%. The S&P 500 was up 18. He recounts this narrative and authentically considers his methodology was sound and the result was misfortune. It was not misfortune. It was the behavior disparity presenting itself in person. Now, there is something particular to 2026 that I have not referenced yet, and it alters the noise equation in a manner that counts. The quantity of financial opinion accessible to you has arrived at a new extreme. Between financial social media, Substack publications, AI-produced market analysis that can generate 10,000 words of conviction on any investment premise in 40 seconds, and a 24-hour news rotation that quantifies engagement in minutes. The marginal piece of financial material you can absorb now carries roughly zero expected value, potentially negative value if it modifies your conduct in a manner that removes you from the escalator. I operate an investing platform. I am conscious of the contradiction. The objective is to utilize information to configure your framework once accurately, and then absorb the minimum required to verify your framework remains suitable, not to be perpetually uneasy and perpetually educated and perpetually on the threshold of executing a decision that seems intelligent but statistically is not. Unease is the behavior disparity producing itself before you have performed anything yet. Now, this is where it becomes genuinely fascinating because there are 3 separate tiers of investor, and the disparity between them is not intellect, it is infrastructure. Tier 1 is the individual invested in nothing, or effectively nothing, with the majority of their reserves in a standard checking or savings account, generating 1 to 2%. Inflation in 2026 is running at approximately 2.5 to 3%. $1 in a 1% savings account in a 3% inflation climate loses approximately 2% of real purchasing capacity yearly. Over 20 years, $100,000 in that account becomes worth roughly $67,000 in today's purchasing capacity. The escalator was not halted, it was operating in reverse. This is the median American financial reality. The Federal Reserve's Survey of Consumer Finances determined that as of 2022, the median retirement account total for Americans aged 35 to 44 was roughly $45,000. The mean was $287,000. That chasm between median and mean reveals precisely how concentrated investment wealth is in this nation. Tier 2 is the consistent index fund investor, automatic monthly deposits, minimal expense ratios, extensive diversification, lengthy time horizon. This is the accurate and comprehensive solution for the majority of individuals, the majority of the duration. $500 monthly into a total market index fund at 7% real return for 30 years generates roughly $560,000 in today's purchasing capacity. That represents financial independence. That represents the escalator performing its function. Most individuals never arrive at Tier 2, not because the arithmetic is challenging, but because they cannot maintain the conduct through 2 or 3 alarming years. Tier 3 is where portfolio infrastructure begins generating meaningfully distinct results. And in 2026 particularly, 2 elements differ from what they were a decade prior. First, concentration exposure inside the S&P 500. As of early 2026, the top 10 corporations in the index constitute roughly 35% of total market capitalization. Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Tesla, the Magnificent Seven have propelled a disproportionate portion of index returns over the preceding 2 years. This is not a justification to forsake index investing. It is a justification to contemplate a partial allocation to an equal-weight S&P 500 fund or an international developed markets fund tracking the MSCI EAFE index, which encompasses approximately 21 developed economies outside the United States. In the 1980s, the prevailing S&P 500 corporations were General Electric, ExxonMobil, IBM. No one anticipated they would be supplanted. No one anticipated that the phone manufacturer everyone possessed would become irrelevant. A BlackBerry share that traded at $140 in June of 2008 is valued at roughly $4 today. The corporations directing the following decade are probably not identical to the ones directing this one. Geographic and structural diversification is affordable protection against that unpredictability. Second, fixed income is no longer dormant. In 2015, a bond fund produced essentially nothing. You maintained it for stability, not return. Today, a U.S. 2-year Treasury generates roughly 4 to 4.5%. For investors within 10 years of requiring their capital, or investors with authentically minimal risk tolerance who would panic, liquidate an equity-concentrated portfolio in a decline, maintaining 20 to 30% in short-duration treasuries now carries genuine expected return attached, not merely downside coverage. The 2022 catastrophe for the traditional 60-40 portfolio, down approximately 16%, its worst year in decades, was a consequence of commencing from near-zero interest rates. That initial circumstance is gone. The bond landscape has shifted structurally. Neither of these observations are a market timing recommendation. They are allocation choices you execute once and maintain. Let me offer you a parable that has nothing to do with equities and everything to do with why mundane prevails. Following the Second World War, Toyota was manufacturing cars substantially inferior to American producers. Their output was slower, less dependable, more expensive per unit. They did not resolve this with a revolutionary technology or a brilliant recruitment. They adopted a philosophy called Kaizen, which translates approximately as continuous modest enhancement. Every employee on the floor was authorized to identify and remedy one modest inefficiency in their domain per day. One process refinement daily for decades. The refinements were imperceptible in the short term and revolutionary over time. By the 1980s, Toyota had constructed the most dependable cars in the world. Not through spectacular action, through mundane consistency compounded over a sufficiently lengthy duration, that the outcomes appeared like a miracle from the exterior. The mathematical parallel to investing is nearly 1-to-1. A 1% enhancement in yearly net return, whether from reducing expenses, optimizing tax placement, or minimizing behavioral erosion compounded over 30 years on $200,000, is valued at roughly $240,000 of supplementary ultimate wealth. 1%. The mundane enhancement. Nobody produces a documentary about it. The arithmetic is indifferent. The escalator ascends the identical pace for everyone. Kaizen signifies you're riding it in a more efficient conveyance. Now here's what nobody is communicating to you about the waiting for a pullback impulse. That is currently in early 2026, maintaining intelligent individuals sitting in cash. The Shiller-Cape ratio for the S&P 500, which quantifies price relative to 10-year average inflation-adjusted earnings, is positioned around 35. The historical average is approximately 17. This has prompted a considerable number of otherwise rational individuals to determine that markets are inflated, and the prudent action is to delay before investing. Here is the difficulty with that reasoning. CAPE has been above its historical average for essentially the complete duration since 2012. Anyone who departed the market when CAPE surpassed 25 in 2012 and delayed for normalization missed one of the most prolonged, sustained bull markets in contemporary history. CAPE is authentically predictive of rolling 10-year average returns. It is fundamentally useless as a near-term market timing indicator. 14 years of evidence on this precise matter says inflated on CAPE does not signify about to correct. Vanguard issued analysis in 2022 studying what occurred historically when you deployed a lump sum at an all-time market peak versus other entry moments. Deploying at all-time peaks generated average 12-month forward returns that were marginally superior to non-all-time peak entry moments. The explanation is mechanically straightforward. The index reaches all-time peaks approximately 30% of all trading days. All-time peaks are a normal characteristic of a rising market, not a caution indicator. The market does not owe you a reduction before ascending further. Peter Lynch averaged 29% yearly returns directing Fidelity's Magellan Fund for 13 years. In the 90s, he stated that more wealth has been forfeited by investors preparing for corrections than has been forfeited in corrections themselves. He was correct then. He is more correct now when the preparation duration can extend a decade and be sustained by an unlimited supply of persuasive arguments. There is a version of this juncture early 2026 where intelligent, financially capable adults are holding 20 to 30% cash, anticipating the AI bubble to correct before committing. If the correction materializes in 6 months, they will appear astute. If it does not materialize for 4 years, which is equally conceivable, they will have missed 4 years of compounding and still sense like they rendered the cautious decision. That is the snare. Caution and immobility carry identical psychological signatures. Now, here's something your financial consultant probably never referenced, and I want to articulate this carefully because it appears more intricate than it is. Tax placement is quietly valued at 1 to 2% of net yearly return for most investors, and virtually no one executes it deliberately. The principle is this: different asset classifications carry different tax efficiency. Equities and broad index funds produce primarily long-term capital gains, taxed at 15 to 20% for most investors. Bonds produce interest income taxed as ordinary income, potentially 32 to 37% for elevated earners. Real estate investment trusts produce non-qualified dividends, also taxed as ordinary income. The guideline maintains tax-inefficient holdings inside tax. Deferred accounts, 401k, traditional IRA, and maintain tax-efficient holdings in taxable brokerage accounts. Bonds belong in the 401k. REITs belong in the IRA. Broad equity index funds belong in the taxable account, where long-term capital gains treatment reduces yearly tax erosion. This does not alter what you possess. It alters where you maintain it. For a $500,000 portfolio with a 30% bond distribution managed this manner, the projected yearly tax reduction ranges somewhere between $500 and $200, depending on your bracket. Over 20 years at compounding, that represents a meaningful figure accessible to anyone with a fundamental understanding of account varieties. Virtually nobody executes it because virtually nobody recognizes it exists. The escalator operates the identical pace. Tax placement is selecting the appropriate pair of footwear for the journey. Okay, now let me share with you what transpired with Marcus. Following the 2022 bear market, where Marcus had once more partially shifted to cash after re-entering at the incorrect moment post-COVID, and once more experienced a drawdown. He performed something I want you to observe closely. He reached exhaustion. Not motivation, exhaustion. He ceased attempting to be shrewd. He composed a one-page document addressing 3 inquiries. What am I deployed in? Why did I select this distribution? And under what particular conditions will I modify it? That third inquiry is where every investment approach endures or perishes. When the market seems frightening is not a qualifying condition. Marcus composed, I will modify my distribution if my time horizon shifts by more than 5 years, my earnings decline by more than 30%, or I am within 3 years of my intended retirement date. Otherwise, the distribution does not shift. I examine it once annually on January 1st and execute no other action. He configured automatic monthly deposits of $200 into a 3-fund portfolio, 60% U.S. total market index, 30% international developed markets, 10% short-term treasury. He deleted the brokerage application from his phone. He canceled every financial publication he had been consuming for 6 years. By early 2026, Marcus is ahead, not because he became more intelligent, because he ceased interfering. His brother David, meanwhile, has been active. David generated 90% in 2023 on a concentrated AI infrastructure portfolio, and then forfeited 60% of the complete account through 2024 and early 2025 as valuations corrected sharply. David's net real return over the identical duration as Marcus's mundane automated approach, slightly negative. David enjoyed more engaging conversations. David dedicated more hours examining charts. David is not ahead. David attended dinner gatherings and articulated his premise while Marcus attended the gym. The escalator is indifferent to your premise. Let me provide you the condensed case study because theory without precise figures is merely philosophy. You are 38 years old, household earnings of $120,000. You possess $40,000 in a 401k you have not accessed since you enrolled. $8,000 in a savings account, generating 1.2%, a mortgage at 5.5%. No additional debt. You aspire to retire at 65 with at least $1 million in today's purchasing capacity. Phase 1. Access the 401k today and locate the expense ratio on whatever fund you occupy. If it exceeds 0.1% on a broad market fund, transition to the lowest expense index selection in the plan. That action alone on $40,000 compounded for 27 years could represent between $50,000 and $150,000 of supplementary wealth, depending on the expense disparity you eliminate. This is a 20-minute action with a 6-figure expected value. Phase 2, that $8,000 in savings. For a household expending $4,000 monthly, a 6-month emergency reserve is $24,000. You are not halfway there before deploying a single supplementary dollar. You must achieve that baseline. A high-yield savings account in 2026 should be delivering 4 to 5%. At 1.2%, you are forfeiting $200 to $300 annually. In interest, you should be collecting on capital you have already accumulated.